As the leaves fall, the weather changes, and holiday spirit nears, what gifts might the Fed bestow upon us? It begs the question, what is the future of interest rates? Also, are higher and lower credit qualities in a race for first place? We're going to break it all down for you right here on UBS Trending. Hello again, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore. My friend and colleague, Leslie Falconio, is back in the studio with me to talk all things rates, all things Fed, all things Treasuries. It's just a nonstop conversation, Leslie, and we talk about it all the time.
It's just all things.
It is all things, all of those things, like just, pick a column and let's just go, right? But I would like to start with you with last week's Fed meeting. The Fed surprised the market. I think once again they kind of hinted that they were shifting their sentiment. Perhaps they said they were indicating another hike before the year's over, slowing down rate declines next year. So kind of a shock, and we've seen Treasury rates, or yields, I should say, react to that. So what's your takeaway from all of this?
We have, and to your point, 10-year Treasury yields today were hitting around, what do you say, like a 460, 463-ish. I have to say, when it goes that dramatic of a move from even the Fed meeting, which was yields were already higher, this is beyond just the Fed, what's going on right now. But before we get into that, you're right. The Fed, although it was expected to have a hawkish pause, they obviously were a bit more hawkish than what was expected, not just because of the one more rate hike that they might have, because that was a possibility. And let's be honest, it's just one more 25 basis points. When you're at these levels of Fed funds rates and the magnitude that they've already moved, that sort of incremental impact on U.S. rates, another 25, not a lot. Mm-hmm. But really it was just the sentiment in terms of how they shifted their forecast to higher growth and a lower unemployment rate, right, which really set off sort of this initial spiral that was encompassed by them, to what you mentioned earlier, taking out Fed easing in 2024. Now, the market had already moved from the 150 basis points of easing that they projected for 2024 in July to, say, 100, and then the Fed went, no, we're only going to go 50, so it readjusted again. Mm-hmm. And there's no question that was a reason why interest rates moved up as quickly as we have. We were at 375 10-year yield at the end of July. Now we're at 460.
Right.
That's a huge move in a very short period of time. Fed, absolutely, but there's other variables that are really pushing this as well, whether it's what's happening with the government shutdown, what's happening with supply. There's other variables here that are making that dramatic of a move in such a short period of time beyond the Fed.
Right. We're going to talk a lot more about the government shutdown with some of our colleagues from CIO in the coming days, especially as when our audience may not even know, but there are certain agencies that won't be able to release economic data like labor data and inflation data that the Fed is dependent on to make decisions. So It's going to be a really interesting time here.
That's right. It's hard to be data dependent without the data.
Without the data, right? How do you do it, right? It's like flying blind.
Right.
But lower credit quality has outperformed this year, but in September, higher quality spreads kind of, remained intact, but we're starting to see maybe some widening in the credit market. Is this a new trend? Or is this something you would have expected?
So one of the things that we look at when we think about where we are in the cycle is look at the capital markets. Are they open? The barriers to credit, and one of the things that we've seen in the high yield sector is that you've had a lot of supply come to marketplace, which is great. They're starting to refinance a bit early.
Right.
So that's a great sign that the capital markets are open, credit markets are fine. But one thing that you and I have talked about numerous times, particularly in the past month, how tight lower credit quality has gotten, right? And we know it's partly because of the yield that they have. Investors are going into that. There's a lot of dry powder out there. They're looking for that sort of incremental total return given the fact that the hard landing is becoming increasingly unlikely. However, when we think about really this month, and finally what we're seeing is that even with the volatility in interest rates, on a spread perspective, corporates are actually tightening in while high yield was widening out. Mm-hmm. So you're starting to reverse a little bit. And I think this is a combination of, one, we're nearing the end of the cycle. Two, we had this really large rise in interest rates, and it takes investors and market participants a step back, because this is all a headwind to borrowing costs, a headwind to the consumer, a headwind to corporations. That if it's sustainable, which by the way we don't believe it will be, mm-hmm. It still could be. It's a headwind to sort of spreads, and now you're seeing high yield widen out, not in a catalyst fashion, very orderly, but the higher credit quality is starting to compress, and that's exactly what we expected, and that's why we like higher credit quality versus lower.
Right. I mean, look at borrowing costs the way they are now, where rates are. And we flashed the 10-year and 30-year Treasury yields up on the screen earlier, and just to watch those charts go straight up. And then you see the borrowing costs that we know a 30-year fixed mortgage is around 7.5%, 7.6%. So, consumers are really kind of bearing the brunt here. But obviously, there's investment opportunities on the other side because you're getting more yield on your investments. So how are we positioned right now as a firm, given this move in interest rates that we've seen?
Look, there's no question. Right now, I feel like I'm swimming upstream.
Yeah.
I just there's that
the
to
tide
have
is coming at you.
To have this magnitude of a move in such a short period of time, I didn't expect that.
It's a head spinner, isn't it?
It is. I mean, not just going from 375 to 4.63 in less than 2 months, but even just over the past week, 2 weeks, it just keeps going. And this is where the catch a falling knife scenario starts to come in.
Right.
But you respect the market in terms of the catch a falling knife, but we don't shift our allocations because we don't think this is sustainable. So one of the things that we do like, and we continue to like, we like those real yields. We think real yields at that 16, 17-year high, they're even obviously higher now, are going to be, in terms of the tips market, are a great sector to be in as we go into 2024, as we slow. And remember, too, our economists are still looking for below trend growth in the fourth quarter and in the first quarter of 24. But we have to see it.
Right.
And I think we will see it. And when you combine the Fed pausing, even if they go 25 in November or December, it's only one more 25. They're near the end of the cycle. So when you have that pausing on top of a few months of slower growth, I really think you're going to see a dramatic shift downward in interest rates. So staying in that higher quality and that barbell of 1 to 3 year IG and 7 to 10 year agency mortgage-backed securities. Our credit weighting is really in the preferred sector, which is a hybrid, which we still continue to think will do well. And recently we've done tips in 5-year real yields. So short term, it's been a little bit swimming upstream, but we do think in the next 6 months, those are really going to do well. Not to mention from a price perspective as yields come down, but also just from the interest and the carry that you're earning.
Right, and let's not forget the Fed indicated, I should say, well, they didn't say, they indicated that they weren't necessarily not going to lower rates next year. They just might slow down their pace of lowering rates. So we do expect, I imagine, that the Fed is going to start lowering rates in 2024 based on what we're seeing.
Absolutely. More importantly, when you pause, the market's going to price it back in sooner. It's hard a year from now. I mean, it's hard to project out.
Of course.
This could be in 3 months. We could be back to, they're easing 125, and you just don't know. But right now, the economy's strong. There's no question about it, and that's great. We want the economy to be strong. But we also think that interest rates are a little bit too high here, and they're moving for some other technical reason outside true fundamentals.
Terrific. Leslie, thank you. Always good to get your insights in a time that, as we say, you got to throw away those old economic textbooks because it's like new chapters are being written as we speak. So good to have you, Leslie.
Thanks very much.
Thanks as always. And for more information from Leslie and the rest of the Chief Investment Office, visit our Insights website at ubs.com/views. And of course, follow us on all the social media platforms, including our very own Instagram channel at UBS Trending, for content out of this studio that you won't find anywhere else. And as always, anything we talked about today, make sure you are speaking with a financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending, everybody. We will see you soon. Thank you.